Last time I looked at some simple planning ideas to mitigate the effect of the pension lifetime allowance, and I'll link to that video in the description. But this time I want to show you that planning to avoid the lifetime allowance might actually not be the smartest thing to do, and that you may be better off just paying the tax. Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. So let's crack straight on into our examples. And fair warning, these examples use pretty big numbers because we're talking about a lifetime allowance here and those numbers are big. If you're in a defined benefit pension scheme and you can see that you're going to be over the lifetime allowance when you retire, you might think that it makes sense to opt out of the scheme to prevent that from happening. But let's look at the numbers to see how that might pan out. Okay, let's talk about Toby, who is in a defined benefit scheme, and he is age 60. He's a high earner, earning £165,000 a year. We're going to assume that his pay increases by 2% a year for the next few years before he retires. The DB scheme he's in is a 1/60th pension scheme, and he's got 32 years membership to this point. He's planning to retire in 5 years at the normal retirement date of the scheme, his age 65. He has Individual Protection 2016. We talked about that last time. That's a method of locking in a higher lifetime allowance. And assuming he opts out and defers his pension, the pension that he's accrued up to that point will revalue at 2.5% per year. And then finally, any lifetime allowance excess, which is paid by the scheme, is commuted at a 20-to-1 factor. That means he gives up £1 of income for every £20 of excess lifetime allowance charge he pays. Okay, so let's see how the figures pan out. In the first column, we've got him opting out now at age 60 and deferring the pension for 5 years until the scheme retirement date. And in the second column, we've got that he stays in the scheme. So the pension he's accrued to date is £85,000 a year. Now, because he's got Individual Protection 2016, his lifetime allowance is fixed at 1.25 million. His pension in 5 years, if he opts out, the 85,000 a year that he's got to this date will just revalue for the next 5 years, and that comes to 97,135. If he stays in the scheme and keeps adding benefits to his pension, they're also revalued, of course, and his pension when he retires will be £110,137 a year. Of course, if he stays in the scheme, he's got additional costs he has to pay into it. So that figure of $30,912 is the 6% of his salary that he's paying in, less any income tax relief at the higher rate. Now, when he retires in 5 years' time, if he opts out, the amount of pension benefit that will be tested against the lifetime allowance is 1.9427 million. If he stays in the scheme, it's higher because he's got more benefits, making it 2,202,740. Well, the excesses over the lifetime allowance are there. Clearly, with a higher test amount, there's a higher excess in the right-hand column when he stays in the scheme. The 25% lifetime charge in each scenario is reflected there. So 238,185 for if he stays in the scheme, 173,175 if he opts out. Now, if his scheme commutes pension to pay that LTA charge at a 20-to-1 rate, those figures show the reduction in his year one pension. So nearly a £12,000 a year reduction if he stays in the scheme versus an £8,600 reduction if he opts out. But still, and this is the crucial point, even taking into account the higher reduction because he's further over the lifetime allowance, he still has 98,228 gross pension versus 88,477 if he opts out. So he's 10,000 a year gross better off. Even taking higher rate tax off that, bear in mind that he's paid 30,912 extra to get these higher benefits. It's only going to take him 4, maybe 5 years of indexed pension at the increased amount to pay back the £30,900 that he's paid extra into the scheme in the last 5 years. And after that, he's off to the races. He's significantly better off every year. So you see, saving a tax charge might not actually make the most sense, even though it might seem like the obvious thing to do. Now, DB scheme figures are always challenging, and the differences between schemes mean that you need to know how your own scheme handles things like excess payments over the lifetime allowance. Okay, second example. With a DC, a defined contribution scheme, it's a little bit easier. You've got a fund, and that fund will get dealt with the same as far as the lifetime allowance is concerned, really no matter what provider or scheme that you're with. And again, it might make sense, at least in the abstract, to try and avoid paying the lifetime allowance at all costs. But I beg to differ. So check out this example. So let's look at the example of Jacob here, who is aged 55, earns £100,000 a year. To keep the numbers simple for me, I'm just going to assume that there's no growth on those earnings. He pays 6% of his £100,000 a year into his employer's defined contribution scheme, which the employer matches, also putting 6% in. He's going to retire in 5 years at age 60. Right now, his fund value is £900,000, and we're going to assume that that grows in terms of investment growth at 5% a year. If he goes over the lifetime allowance, he's going to take the excess as a lump sum. So he's going to pay a 55% lifetime allowance charge on it. Okay, 3 columns this time. 1, if Jacob opts out entirely. The middle column is if he carries on in the scheme, but only the employer pays in. That'd be nice if he could wangle that. And then the right-hand column is if things continue as they are, with both Jacob and his employer paying in. So I calculated what the lifetime allowance will be in 5 years, assuming we're starting this in the middle of 2022. The LTA is fixed until 2026, and then I've assumed that it goes up by 2% for 1 more year, giving you the figure there, which is the same in each column. Now, using the assumptions, these are the fund values when he gets to age 60 in 5 years' time. So the difference between 1.148 million on the left and 1.218 million on the right-hand side. That's simply the difference made by the additional contributions and the growth on that extra money. Of course, if Jacob opts out of the scheme, in the first 2 columns here, he doesn't pay anything else in. But if he continues as he is now, he will pay £30,000 in over the 5 years. Take higher rate tax relief off that, and that takes it down to $18,000 net contribution for him. Now, given the size of the funds at vesting, these are the amounts over the lifetime allowance that he will be at that time. With a 55% LTA charge to pay, those are the figures. So if he opts out, his LTA charge is only about £30,000, $29,750. Whereas if he stays into the scheme and both he and the employer continue contributing, then his LTA charge will be £68,000, more than twice the amount. So taking the charge off the excess, the net lump sum which will be paid to Jacob is $24,341 if he opts out versus $55,671 if he stays in. So even though he's paying more tax, he'll have more money after tax. And of course, once the excess has been paid out, the fund reverts back down to the lifetime allowance at that point. So even factoring in the fact that in the right-hand column he's paid in £18,000 extra over the last 5 years, even if you take that off the $55,000, that's $37,000 that he's better off, you could argue. Now that's better than the left-hand column, the 24,341, slightly worse than the middle column. So if he could stay in the scheme but only have his employer pay in, then financially that might make the most sense, but I'd like to see him try. So you see what I mean? It isn't as clear-cut as you'd think, and that's why I'm pretty sanguine about the lifetime allowance. There are just other elements to your planning that might actually trump the impact of that particular tax. Okay, I hope this is useful so far. We've got one more example to show you, but if it is useful, you know what to do. Hit the like button, subscribe to the channel if you're not already. It really, really helps us out, so thank you in advance for doing that. Okay, finally, I want to show you an example that is a real client case that I've been working on just this week, and the numbers are pretty stark. Let's have a look. Okay, I'm not going to give you names here, obviously, because this is a real client, but basically what you're looking at here is 2 cash flow charts. The top one is if he does nothing. He has a pension fund currently of about 1.7 million, and if he leaves that untouched, based on the calculations and the assumptions that we've made, he will end up with a lifetime allowance charge, if you can see that here, of about 416,000 when he's age 75. Now at the bottom, what we attempted to do was to fully crystallize his pension now, early, and the orange bar you see here in year 1, that's his tax-free cash paying out. And then the pink color as you go on is I've got him drawing $35,000 a year out of his pension to try and keep his value down to minimize the charge at age 75. And you can see it is lower. It's down to $271,000 versus $416,000 in the top example. So far, kind of so good, but it's actually not as easy as that. So if I go into the detail here and look at his age 75 and go into the taxes, I can see cumulative taxes at his age 75 is £416,000. So that's lifetime allowance plus a little bit of capital gains, actually. So the total is 431. Whereas if I try to address his LTA by vesting early and drawing income from his pension, he's obviously going to pay income tax as he goes. So his lifetime allowance charge is reduced to 271, but by age 75, he's paid £123,768 of income tax throughout those years. So actually, the difference, if you look at the total, 395 versus 431, £36,000, it's helpful, sure, but it's not really a reason to do one or the other. So if I take a random point here, let's say at his age 90, and I'll just lock in those figures. If you think about what's happening, in the top one where I don't do anything and his pension is pretty much left as it is, this client has enough other assets that he really never needs to touch his pension. Well, you can see that at age 90, his pensions are worth $6.1 million. His other assets are there, and that adds up to a net worth of $10.2 million. This is not inflation adjusted, folks, so it's nominal, okay? In fact, why don't I fix that? Okay, so this is now inflation adjusted, and you can see that at his age 90, his net worth is £4.3 million, with 2.5 of that in pensions, making just about 1.7, something like that, in investments and property. So if I try and address the lifetime allowance as I'm doing in the bottom chart, you can see that the balance of assets is completely different. And so now he only has, in inverted commas, $955,000 in his pension fund and $3.5 million in investments. The property is the same. But while the headline figure is that he is £1 million better off, once you factor in inheritance tax, that's not the case. So essentially, in the bottom chart here, $4.5 million of his $5.3 million net worth is going to be taxed at 40%. Well, that's a £1.8 million inheritance tax charge. Take that off the total, and we're down to about $3.5 million. Whereas on the top, if we take inheritance tax off the roughly $1.7 million that is not in pensions, he's going to have an inheritance tax charge of roughly $650,000. It's going to take the pot down to what? Around about 3.7, something like that. So chances are he's going to be £250,000 or so better off in the top scenario, even though he's paid more lifetime allowance charge. So in this case, it was the inheritance tax that really makes the difference. The lifetime allowance charge and income taxes, depending on how much income we take, they kind of almost cancel each other out. But there are other things in play, in this case, inheritance tax. And obviously, there are a ton of variables in every single case. And the reason I have a job is to try and run these calculations for each individual client that we work with and try and work out something of an optimal path through their specific circumstances. Now, you might be surprised to know, or you might not, that I often end up advising the client to ignore the lifetime allowance in favor of trying to do something about other far more punitive taxes, like inheritance tax. So if you've been following the videos for a while, you can see, hopefully, that financial planning is never straightforward, and that's particularly true at the higher net worth level. Okay, I hope that was useful / interesting, folks, and if it was, hit the like button, subscribe to the channel if you're not already, and maybe leave a comment about what surprised you or whether it was just exactly as you thought it would be. Let me know what you thought. Thanks so much for watching, and I'll see you in the next video.